Hey YouTube, it's Matthew Decker, Leveraged Wealth Management. Today we're talking about Indexed Universal Life Insurance, illustration wars, and creating paper tigers. So when it comes to indexed universal life insurance policies, we've been saying for years now that you really have to pay attention to the contractual provisions within the illustrations themselves. There's a lot of different companies out there today that don't necessarily have the best product, but they might look the best on paper, and we would call that a paper tiger. And so we're just going to kind of peel back the onion here on one particular product and show you how to identify whether or not you're dealing with a product that has good contractual long-term provisions, or if you're dealing with a paper tiger. So I'm going to share my screen here, and we're just going to go through this kind of one at a time, step by step. So the first thing that you really have to watch out for is going to be what type of bonuses exist on the actual policy. It's important to know that most indexed universal life insurance policies nowadays have bonuses. And what you need to ask is that bonus guaranteed, or can it change? And if it can change, how can it change? And then the third thing being, what bonus is actually being reflected in the numbers on the illustration? That's all super important for you to be able to know to decide whether or not a policy is going to be something that's actually worthwhile long term. So what we're looking at here is one particular bonus on a product that's being sold today. And this is not the only one, but we're looking here, interest bonus on the indexed account, okay? And so we're looking at this whole box here. And what I want to point out is this particular policy has a huge non-guaranteed bonus. And let's just read it. So it says, if you use the Fidelity Multifactor Yield Index, you're going to get a non-guaranteed bonus of 1.65% in the first 10 policy years, moving up to 2.65% in every year after the 10th year, year 11 plus. Okay. That's a huge bonus. I don't need to tell you that. We're talking about an additional 2.65% in every year starting in year 11 for the lifetime of the policy. And that 2.65% bonus is being reflected in the illustration itself. So the first question that you have to ask is that bonus guaranteed? And when we look at the illustration, it's pretty obvious that it is not. It's a non-guaranteed bonus, non-guaranteed. Okay, so it's a non-guaranteed bonus. Well, what about the bonus is guaranteed? Is there any contractual element to this bonus at all, or is it just a complete phantom bonus that really doesn't mean anything? Well, if we look at the second bullet point here, we'll see that there is a guaranteed element to this bonus. It's guaranteed to be 0.5% in all years. Okay, so there is an element of this bonus that's guaranteed. I'm guaranteed to get 0.5%, but the illustration, if I choose this Fidelity Index, is showing me 1.65 and 2.65, but only 50 basis points of that is actually guaranteed. So that bonus right there is setting itself up to really be an illustration game, to really turn this product into a paper tiger, because this is a new product. It's only been in existence for about 2 years, maybe not even a full 2 years. And so there's literally no policy. There's not one single policy that has been sold that is earning 2.65%. I'll say it again. Not one of these policies that has been sold is earning this 2.65% bonus, because it's a new product and none of them are in year 11 or higher. So you're seeing an illustration showing a 2.65% bonus, and there's literally no track record of this company ever paying 2.65% to its policyholders, and they don't have to All they have to pay is 50 basis points. So the first thing that you need to be looking at is bonuses. It's a huge area where companies can overpromise and underdeliver. And I would say that this is absolutely overpromising and underdelivering. Now, on this particular policy, there's actually two bonuses that we have to contend with. And those two bonuses would be number one, on the indexing account, but there's also a bonus on the loan account. So you can see here that there's three different types of loans on this policy. We have variable loan, standard loan, and fixed interest participating policy loan. This illustration is using this fixed interest participating policy loan. Now, let's dive into this just a little bit because it's just further evidence that there are paper tigers out there. I'll say it again. In the indexed universal life insurance world, there are paper tigers out there, and you don't want a paper tiger. You want a policy that's actually designed to work long term. And there's a lot of them that are not designed to work long term. They're designed to look good on paper before you purchase it. Those are two very different things. So fixed interest participating policy loan, let's just really quickly dive into the fact that this is not a fixed interest participating policy loan. A fixed interest participating policy loan would say something like your loan rate is 5% guaranteed in all years, or your loan rate is 4% guaranteed in all years, or 6% guaranteed in all years. But when we actually read this, the initial fixed rate participating policy loan interest rate used for the non-guaranteed basis is 5%. Going to the next line. The initial fixed rate participating policy loan interest rate used for the guaranteed basis is 8%. So I'm confused. Is this a fixed interest policy loan or not? Because it looks like it's showing 5%, but it could be 8%. Again, paper tiger, right? It says it's a fixed loan, but then it has an out for not being some kind of fixed loan. But that's actually not why we're talking about this. That would be a topic for a different video. I want to talk about the fact that there's a bonus on this fixed interest participating policy loan. The initial interest bonus on fixed interest participating policy loans used for the non-guaranteed basis. Okay, so there it is again, that first question. Is it guaranteed or is it not guaranteed? It is not guaranteed. Is 2%. So if you use the fixed interest participating loan from this particular company, they're going to bonus you in the illustration an additional 2%, but it's not guaranteed. Okay, well, how much is guaranteed? The initial interest bonus on the fixed interest participating policy loans used for the guaranteed basis, so what's guaranteed, is 50 basis points again. So we've got a 2.65% bonus on the index that is not guaranteed. Only 50 basis points is guaranteed. And we've got a 2% bonus on the loan, which is not guaranteed. Only 50 basis points is guaranteed. So it doesn't take a calculator to figure out that there are loads of bonuses on this policy being shown on this illustration that do not contractually have to be paid. And in fact, there's probably not a single loan, or there's not a single policy that's getting both of these bonuses. Well, there's not a single policy that's getting both of these because you have to get to year 11 to get both of them at the high watermark. And there is no policy in year 11 because it's a new product. So that's why I say you got to be super careful when looking at these indexed universal life insurance policy illustrations, because the illustrations can be guaranteed or non-guaranteed, and they can be set up to overpromise and underdeliver. And there's a lot of them. There's probably 4 or 5 of them that are out there that are selling a lot of policies that a lot of people are pushing because it looks good on paper. But when you peel back the layers, you see that, oh, wow, okay, well, it looks good on paper, but none of it's real. It doesn't have to be real. It could be real, I suppose, if the company decides to give you 4.65% in bonuses, even though they don't have to, then yeah, okay, maybe this works. But what are the chances that the company gives you that much in bonuses when they don't contractually have to, and they're not doing that on a single policy that exists right now? So the first thing you really got to watch out for when it comes to paper tigers is bonuses, okay? The second thing that you have to watch out for is fake index options. And when I say fake index options, really what I'm referring to are newer volatility indexes, and this fidelity index would fall under that category. It's a volatility controlled index. Newer index options that tout a really good return and yet have no historical. I'll say it again. You have to watch out for new index options that are being shown on these policies that look like they have really good returns, and yet in reality, they have no historical. So let me show you exactly what I'm talking about here when it comes to this policy. So I've moved over to the color-coded illustration just because it's a little bit easier to see. But what we're talking about here is the Fidelity Multifactor Yield Index. And you can see that it's got basically no cap. It's got a high par rate, all this stuff. Okay, so this is their volatility. This is the brand new volatility controlled index on this particular product. And if we go to the next page, we can see, okay, we've got this historical index change detail. So here's our Fidelity Index. And you can see it goes all the way back to 2002. And let's just call out some of the highs and lows. We got an 11.5 in 2003. We got a 13 followed by an 11 in 10 and 11. We've got a 12.6 in 2014. We got a 13.6 in 2009. Average 6.4. So, okay, that looks pretty darn good. 6.4% in this volatility controlled index. It's uncapped and it comes with all these bonuses. Man, why wouldn't I choose this Fidelity Multifactor Yield Index that has this great historical data going all the way back to 2002? Well, the reason that you wouldn't choose that index is because none of that data is real. None of that data is real. This index has not existed all the way back to 2002. It's basically a brand new index. Let me show you. You go to the Fidelity website and you just type in Fidelity Multifactor Yield Index 5% ER and you can see something like this. So here it is, straight from the Fidelity website. We've got a 1-year return of -4%. And this inception date of this index is December of 2019. December of 2019, which means all the returns we just looked at are all fake. They're back tested, which means the index was built at the end of 2019. They built a trading algorithm that moves money around based on volatility, but they had the answers to the test. They have the data going back to 2002. And so if you're building an index at the end of 2019 and you have all the data for the last 17, 15, 20, 30, 40, 50 years, you have all the data. It's very easy to build an index that has a good track record of returns, because you have the answers to the test. And so when we actually look at this index, if it was built in December of 2019, we really only have 2 returns. That would be December of 2020 and December of 2021. That would be the only 2 returns that even exist. And we're talking about 4.9 and 3.8. And this is probably measured January to January, I would assume, December 31st to December 31st. Okay, so it's actually pretty close. So the 2020 and 2021 would be the only 2 returns on this Fidelity Index that have actually happened. All the other returns are fake, back-tested returns. The index didn't even exist in all of these years. So let's put this all together. What does it mean? Well, in my opinion, it means that this is absolutely a paper tiger that's set to overpromise and underdeliver. And when we look at the illustration, that really couldn't be any clearer. So here's the actual illustration using the Fidelity Index. So it's got all the bonuses on there, and we're using the fake the index that hasn't existed, for 15 years, but we're using the 6.24% number. So we're using the historical return of an index that doesn't have a historical return. That's fine. We're also showing the full bonuses, the 2.65 year 11 plus, the 2% on the fixed loans. We're paying $15,000 a year for 22 years. And then we turn on a lifetime stream of income, $73,000 a year. Wow. So you put in $330,000 into this policy and it generates $73,000 a year tax-free for life with no market risk and a fixed product. Are you kidding me? Sign me up right now. Right now. Okay. Paper Tiger. It looks great. I mean, who wouldn't want to do that? Put in $15,000 a year, $330,000 in premiums, and you generate $73,000 tax-free with no market risk for life and a fixed product, and you have a death benefit. So if you die too soon, your family's taken care of with a death benefit. If you go out to life expectancy, this product is essentially, at 82, it's showing that you've already taken out $1.3 million for the $330 that you put in, and you still have $200,000 in death benefit at 82. Okay, here's the problem. All of this cash, this income, this $73,000, it's based on all the things we just talked about. It's based on that 2.65% bonus in years 11 plus. It's based on the 2% bonus on the fixed loan rate. And it's based on that fidelity index that doesn't have a track record that it says that it does. And of the bonuses, between the two of them, only 50 basis points are guaranteed on each line item, so a total of 1%. So what would happen if instead of using this fidelity index that has these fake bonuses, what if we just use the standard S&P index and we stripped out the bonuses that are non-guaranteed? What happens to the income? Well, I've already done that, and I'd like to show it to you. So here it is, $15,000 a year for the same amount of time, 22 years, and we do a lifetime stream of income, and we're generating $33,000 a year tax-free for life with no market risk, which is actually still a pretty darn good return. You put in $330, at 82 you've taken out $600, you still have $343 left over in death benefit, but this is nowhere near what was positioned to the client. The client saw $73,500, not knowing that that $73,500 is based on non-guaranteed elements in the policy that can change on a whim that don't have to be paid, and that the 6.24% is based on an index that hasn't existed for more than 2 years. You show them something that's real, the S&P index that has existed, that does have a track record, that doesn't have fake bonuses, and all of a sudden you get into a situation where your income is more than cut in half. And that's why I would say it's super important that you're working with somebody that can understand and articulate the differences in these products. You can't just look at an illustration and choose the one that looks the best. That's not how it works, because these companies are trying their darndest to have the best looking illustration on paper, because they know that the majority of their agency force is not reading the fine print, is not doing the research on how the numbers are actually coming to be. And so if they look the best on paper, they will grab market share. And that's unfortunate, because looking the best on paper is not the name of the game. The name of the game is, let's build the most viable product long term that has the best opportunity to fulfill its promises. Not let's build the thing that looks the best but really doesn't have any teeth in it. Like, that's not, as a consumer, that's not what you want. As the company, if they can look the best on paper, they can fool a lot of people. So I would encourage you, if you're looking at an index universal life insurance policy, you have to be working with somebody that understands these policies, that understands the non-guaranteed and the guaranteed elements, where companies can kind of move the line or move the goalpost. Like, what wiggle room do the companies have to change these policies after they've been issued? That's super important, because you need to be, if you're pursuing this for tax advantaged income, you need to make sure that you're working with a company that has as little wiggle room as possible in terms of their contractual elements. And you need to be working with a company and working with an advisor or a fiduciary or a CFP even that understands these products, that's looking for the product that gives you the best likelihood of achieving what's on the paper, not the paper that looks the best. So if you'd like help with that, let us know. You can go to our website, leveragedwm.com/contact-us. I'll link it below in the description, or you can leave a comment below, whatever's easiest for you guys. But man, I can't say it strongly enough. There's 4 or 5 of these paper tigers out there in the industry, and they are selling a ton of business. And it's because people aren't doing the research, or they don't know how to do the research. So if you'd like to work with somebody that knows how to do the research, that's already done the research, that can articulate the differences between these products, then you need to be working with us. And you can start that process by going to leveragewm.com/contact-us, or you can go to the IUL review page, which we will link above. Thanks so much for taking the time with us. Hope that you liked this video. If you did, click the like notification and the bell so that you can get notified when we send out new content. Share this with your friends, and comment below on videos that you'd like to see in the future. This has been Matt Decker, Leveraged Wealth. Until next time. Hey, it's Matthew Decker, Leveraged Wealth Management. I just want to give you an opportunity to book a discovery call with us. We get tons of emails, phone calls, voicemails every single week for people asking for policy reviews, as well as retirement planning scenarios. And so if you're someone who feels like, man, I have one of these index universal life insurance policies, number one, I don't know if it's any good, or if someone's proposing an index universal life insurance policy to you and you want to get it reviewed, I'd encourage you to book a discovery call with us. It takes maybe 15, 20 minutes. We ask you some questions. We get a feel for what your goals are, what you're trying to achieve, and then we'll do a full policy review for you at no cost. And so you can book a discovery call with us there. And at the same time, if you're one of those people that wants to kind of get on the ball as it relates to retirement planning, and you want to go through an entire holistic retirement plan, get your point A, your point B, and figure out the best, most efficient way to retire when and how you want, you can also book a discovery call for that as well, although that process is a little bit more time intensive on your side. But I just wanted to offer that up to you only because we have limited time and limited availability. But if you're one of those people that's serious about their finances, you're serious about figuring this thing out, then I'd encourage you to book a discovery call, and we can't wait to talk to you.